Welcome to Jay's Corner. My name is Jay O. I'm the author of Maximize Your Medicare. I'm also an education fellow at the Alliance for Lifetime Income. You can find all of that information on the Substack, the jo.substack.com. Be sure to go there. That is your place to get all the information that I'm sharing here today, plus a lot more. Paid subscribers get special access to videos and information that I'm not able to share in public. There's a lot of reasons for that. I am the highly regulated. I have people and organizations to protect. We're going to get into that as we go here. So we're going to move quickly here. I'm going to try to keep it within an hour as usual. We'll see how successful I am at that. This is where we are going here today. Let's see if we can put us here. This is the newsletter as you can see it there. And, this is always about you. This is not about, one size fits all. It reminds me of one of my favorite movies. Hopefully you've known this scene. If not, please go see it.
Which one is you?
What do you mean?
I mean, which one is you?
None of them. They're just pieces.
This is you.
Absolutely. Absolutely. I can't even tell you this, right? Which is that you can see through the common thread is going to be always that I'm going to be talking about the base case and picking apart things that are not really revealed, shared with you in a way that you can understand in clear, actionable ways for you. Nevertheless, that doesn't mean the fact is that you need to tailor them to your individual situation. I want you to, so that you can get the best outcome for yourself. And here we go here. So let's just get right into it. Medicare mess. I titled that the video here, and every piece of data, every input I get, every piece of insight I receive, information I receive leads me to this conclusion. I can't come with any other conclusion. Just eliminate what's not possible, and and then what you end up having is what's going to occur. Right? The old Dr. Spock from Star Trek. And Sherlock Holmes, from what I told. I didn't read Sherlock Holmes. So a lot of it has to do with, the base case and KFF report on Medicare. I will include the link. I think I've done so in the description here about how complicated the situation is. 66 million people on Medicare. 66 million people on Medicare. And you can understand here on Jay's Corner, Maximize Your Medicare channel, KFF is very frequently used, both in positive and negative. I have thrown rocks at it, but make no mistake, this is top of class, right? I wouldn't spend time, giving credence to the underqualified. This is the highly qualified, top of class, as I stated. So shout out to them, of course. And now they give a very good brief overview about the kind of current state of play, meaning, what is it, who's covered, and you can see it here. All of this stuff, obviously, in Maximize Your Medicare. And you'll see the size of the issue here, which is the share of U.S. adults who at 65 years old projected to go from 17% to nearly a quarter in 2060. And as you can see it here, 60 to 93 million in 2060. Now that's a long time away, right? But you can still see it here. Even here in 2020, here's where you are. You're talking about half the population is between 65 and 74. And so now you can see it here, which is the state of health. We'll get to Wegovy shortly. But you can see it here, which is half of all people had incomes below $36,000 a year. $36,000 a year in a time when you've had Cheerios at $7 a box, right? And so now you can understand my point. This is simply your takeaway here is you can understand why I'm this even-handed when examining Medicare Advantage versus Medigap. It's very easy and convenient to say Medigap always, because it is the superior standardized grandfathered contract. That is true. True. Technically speaking, as a contract, all the parts don't move. That is in the buyer's favor, period. Okay. That said, it costs money. And that money is money that many people simply, from a practical point of view, do not have. The example in Jay's Corner I like to say, you're the old man who lives in a shoe. You have 700 children. You don't know what to do. You live on Social Security alone, and you are never sick. Guess what? Medicare Advantage, for all the noise and crossfire around it, is the rational, reasonable selection you would make. Now, that has an asterisk, right? You still have to deal with network. You still have to understand the fact that this is annual contract. These things that I'm reviewing in Maximize Your Medicare so that you can understand what you are signing up for. Again, it's a common thread through Jay's Corner, which is I'm not going to tell you don't take any risk. Risk is everywhere inherent, uncertainty inherent. That is just part of waking up in the morning. I get all of that. It is the unintended risk that I'm trying to help you avoid. From there, if that's your choice, that's your choice. That is your priority. I'm not here as your clergyman, clergy person, right? Or personal philosopher, philosophy guidance counselor. That is not my role here. I'm not trying to be that. I am trying to be a person to give you clarity so that you can be empowered to choose for yourself. And now we go on and you can see it here. Very, very clearly, this is why Medicare Advantage simply cannot go away, right? You've got too many people at $36,000 a year. Half of 66 million, that's 33 million for those keeping count at home. So now we can talk about some overview of Part A, Part B, Part C, which is Medicare Advantage. Here it is. And now you've got prescription drugs. We're going to get into that here. And we're going to get into the physicians here. So anyway, I'm not going to keep going on to it, but it was my main point about the Medicare Advantage, why it is not going away. It's important to understand it, especially for those people who face financial challenge, of which there are many, many. The other day, I recorded a snippet with Bob Powell, and this is the second one, Retiree Health Insurance. And this is going to, for those people who have worked for large companies as well as governments. And here is what we said, and I'm not going to play the entirety.
In 2024, a majority of states will offer Medicare Advantage plans to their state retirees. And here to talk with me about that is Jay O, author of Maximize Your Medicare. Jay, welcome.
Thanks for having me, Bob.
A pleasure. So, a new trend developing for state retirees.
Actually, I think it's just coming into the news, Bob. It is reasonable, it is rational. You can understand that state, local governments under tremendous fiscal pressures of their own, and you've had entire retiree systems where the money came from tax dollars being switched. For example, very famously a number of years ago, Texas teachers entirely. The retirement system was switched, notably leading to something like tens of thousands of people instantly leaving the retiree health benefits program. So what has happened is instead of the health insurance packages or plans that they were used to, accustomed to, which mimicked kind of the plans when they were active employees, that those employees, once retired, get converted to Medicare Advantage plans. And this has caused controversy just due to the crossfire regarding Medicare Advantage plans alone. And let's stop it here. I'm going to turn on the camera. So rather than continuing on, what I'm going to do is give you my comments here, which is that this is not news, right? Which is that retiree health insurance converting to group Medicare Advantage. And this is the takeaway. right, which is in New York State, for example, they're trying to do set people up in arms, lawsuits around. The reality is it would save the entity, New York State, City of Chicago, State of Illinois. They have saved a lot of money by converting people to Medicare Advantage and still trying to say, okay, we are doing right by our retirees. It is the rational thing. This is the point of healthcare cost planning generally, which is the crossfire. The stakeholders are not irrational here. No, I would not make that statement. Now, whether or not, the question is how you are going to be accepting it, how you take it, right? And for some people, this is going to be a blessing, right? Because the fact of the matter is that retiree health benefits may have had a cost, and those costs may go down to zero, other than the fact that you have to be enrolled in Part B. So that is absolutely here, but it then points out my point here, which is that it means, so in Maximize Your Medicare, I go through Medicare Advantage. Just because it's group Medicare Advantage still makes it Medicare Advantage. Now, that means that all of the other matters have to be understood. Annual contract, understand the network first, understand your prescriptions is usually included and can be look and feel different than a standalone Part D plan. And then there are extra benefits. All of those are all still true within group Medicare Advantage. That also means, and this is why I think it's going to be a mess, which is that the payments to Medicare Advantage are flat at best or down, right? Depending on who you ask. And who does that affect? That affects who? The carriers who are trying to assemble the jigsaw puzzle to create Medicare Advantage plans. And they've already told you. They've already told you. You've had earnings reports now. And it's not just one carrier who's just like incompetent. No, that is not what is happening. What instead is happening is the list has just, everyone has taken the podium and everyone said the same thing. Humana, United Healthcare, Aetna, the biggest. They've all said the same thing. That the squeeze in putting together this jigsaw puzzle is difficult, challenging, but yet competitive, which has worked hugely in your favor, right? That's why silver sneakers is included. That's why dental and vision is included, etc. Light dental and vision can be included in your Medicare Advantage plan. Simply put, what it was is that the sellers, the carriers, are taking their allowance, something that I've explained in the past in videos on Maximize Your Medicare channel. And they have allocated, and then, oh yeah, by the way, they know they've got a very competent competitor across the street. 7-Eleven, Circle K across the street. There's a reason I use the example of the fact that I'm just wearing a 7-Eleven smock. Right? I'm not changing the price. That's not legal. Right? There's no massaging of the contract from someone like me. That's just like not even a topic. What is the topic, however, is the CEOs are warning you. Let's continue. It's going to get worse. And part of that input has to do with the Inflation Reduction Act. So, how can I put this nicely? If I were Gen Z, I understand the phrase #OKBoomer. And the reason is simple. That the Inflation Reduction Act is basically ARP wins. The end. Which is next year, in 2025, you're going to have a $2,000 out-of-pocket max for Part D. That is incredible. This single line alone, which I've highlighted the entire time that I was dealing with the Inflation Reduction Act and educating people, informing people on what the provisions were, is on that alone. Now, all of a sudden, you can understand my place, my corner, right? Which is your estimates of cost here now have been capped and certain. Both. So you had some $10,000 a year medication. Guess what? So now it's 75% off. So now it's $2,500. Even that has gone down from $2,500 to $2,000. And oh yeah, by the way, you don't worry that the next year it's going to be $4,000. Even if the sticker price of the medication goes from $10,000 to $20,000. You are capped. It is a huge win for existing Medicare beneficiaries. I don't think that there's any way to sugarcoat it or state it otherwise. Just don't. The issue is the feedback loop, right? The feedback loop is back up to here, right? Which is, you're the adolescent child, you got an allowance, you didn't have any say. And oh yeah, the government, your parents just said, oh yeah, by the way, you can only buy 3 big gulps with your allowance. That's it. And now you got to, or for actually better stated, you have to buy at least 10 copies of hardcover books. I'm going to give you this allowance and you can do what you want, but you've got to do this. Well, that's the Inflation Reduction Act, right? The stuff that they're going to require in Part D and Medicare Advantage plans is going to be tougher, a lot tougher. And then we have Wegovy. So over the past couple of days, or over the past month or so, I spoke with Bob on thestreet.com, Retirement Daily. Please check it out, thestreet.com. Robert Powell, legendary financial journalist, absolutely icon, is Wegovy's use for hypertension. So quickly, I will tell you, right? You cannot just go up to your primary care physician and go, hey, I would love to drop 20 pounds. Can you prescribe Wegovy for weight loss, even though I'm Mr. or Miss Perfect? No, that will not work. Okay. You can only have Wegovy for specific medical condition, and the doctor has to put their name to it. I'm going to stop comment from there. Now, the issue is that Part D and Medicare Advantage plans have to take this into account in their allowance. Right? This is a $400, from what I understand, $400 a month medication. So now you've got to make this fit in your allowance. Again, we're back to the balancing act. And then, of course, as I've stated above, and I've told this to people, and I'll share it with you privately, right? And I've said so in the past, right? Doctors are taking a pay cut. So if under original Medicare, just red, white, and blue card alone, right? The doctors are currently, right now, today, have taken a pay cut. And now you can understand why I wrote Maximize Your Medicare, because I'm like, look, the bottom line is you can do everything that you want for yourself. Eat well, exercise, no Jack Daniels before 8 a.m., whatever you want from a lifestyle perspective and habits perspective. There are certain things you simply don't control. And this demographic and fiscal reality, right, which I've now highlighted for you here, right? These are things you do not control, but yet do have a role in your decision making and understanding. Both. I knew it was going to be. We had a lot today. Let's just continue here. So the impact on consumers, then, of course, should be self-evident. Obvious. I like being Captain Obvious, right? I'm not a good salesperson. I don't like making coin flip sales. That's like makes no point. The impact on consumers, and it has never been a good idea, but I think that what you are going to see is when we provide our counsel or guidance to people, we say, okay, given your inputs, here's the efficient solution, which is the ultimately the cost minimizing solution where you still get to access the healthcare providers that you want to, based on your situation, location, age, the whole kit and caboodle. All at once, yes, that's true. The issue is since all of the cards are going to be shuffled as a result of this top section here, because of this top section and all of these factors being moved around, the ones I have highlighted in green, the only rational conclusion is that the impact on consumers is going to be high. And the reality is that this year we have seen it. We have seen it, but not to the degree that we will see it next year. I think that next year, like I said, that's why I called it a mess. I just don't see any logical, rational way, other conclusion for that. And don't get me wrong, while today is not a pity party, right? The impact on myself and other financial guidance people involved in Medicare matters is not going to be zero. Is not going to be zero. You will see less. You will see less commercials. I don't think that rightfully or wrongfully, there are going to be less, right? There's wrongdoing. The rules are understood. There's usually a very good reason for rules. I think that's going to be the case. That's true. There's a way that you don't get called by tons of people on Medicare matters. You should not be getting unsolicited calls during this time of the year, especially if you are already enrolled in Medicare Part A and Part B. That is not legal. I've already discussed how to avoid fraud, which is simply ask the person, tell me your NPN number. And then they can't transfer the call to another party. Those two alone shut it down a lot. That will cut down on a lot of the problems. That said, there are still problems. I've told this to people on the newsletter. I'll say it again here today, which is certain carriers are going to be paying people like me zero for the guidance that I provide. Now, I believe in doing the right thing. That is first and foremost. That is true. And that will always be true. Right? This is like these other standards like fiduciary suitability. I just kind of shrug myself and think, what other standards are there? That's like crazy to me. But they must exist for a reason. I don't know what they would be. But for example, that is part and parcel from over here. That said, the issue here is the following. Is I'm out there a lot. And now, as I stated at the beginning of today's presentation, I'm sitting there not only protecting my book, but I'm also protecting my colleagues at the Alliance for Lifetime Income, which include the ex-chief economist of Social Security Administration. Hello. Shout out to you, Jason, right? I mean, which is simply that, and he's not alone at that caliber of professional experience. He's not alone. So I sit in a room of like 17 of us or something like that, right? I'm not there to risk them either by association. That other role is too important at too high a level, right? I'm just a guy, a private citizen, who wrote a published book. And so on top of the insurance carriers and the states that I have to follow their regulations, what I'm trying to get to you is the following, which is that does not preventing someone with the, Mr. or Miss entitled and thinks that all financial people are evil, complain, I've got to set down all my work just to swat it away. I'm not going to do the wrong thing, but the burden of proof then wrongfully shifts to me. Now, The reason I went on this, tangent is I'm fine with that at low pay because I believe in doing the right thing, but not at zero. And now any reasonable person can understand that balance. So I'm going to be having to make tough choices. I'm not 23. If I were a new college graduate and I had no book of business, had no other resume, had no other experience or affiliations, guess what? I would probably provide that guidance for free and take the risk. That's not the case here. And with that, you can understand the point here, which is, let's go to the second segment, which is I'm going to be speaking at the Financial Planning Association annual conference. So, for example, and for the reason I put here is not to flex at all, right? I People can look on about me. That's totally fine. I will. True, I'll stand by it, no problem, right? I don't like to talk, to be candid with you. I am an introvert in public. The reason is I don't want to go down the wormhole of talking about what I do or know and hear some distortions about financial stuff, and then I have to say, oh no, and then I'm a jerk. Well, take a number. Lots of people think that. That said, that is different than being underqualified. That is different. This is the description to that annual conference. And, I kind of went, oh, and et cetera, probably, anyway, 1,500 is 60 speakers. So there are 60 of us, apparently, I'm headed to enemy territory, to Columbus, Ohio, home of the Ohio State University. I'm gonna find some sign and delete the IO and State University and just the O, and then it'll be correctly spelled. But and then I'm also thinking about playing "Hail to the Victors" as background music during my presentation. I'm not just for fun. Then again, this is going to be a serious thing. As I apparently this is a serious thing. So the bottom line here is this is not my first time. Okay, this is not my first time. I've spoken in Nashville Investments and Wealth Institute, which gives lots of fancy letters behind everybody's name. CMA, CMA, for example. CIMA, Northern Michigan. There's like an interdisciplinary matter amongst professionals. State Bar of Michigan. That has not only been the Elder Law and Disability section, but in addition for the Institute of Continuing Legal Education. Thank you to my colleague and compatriot Sanford Mall in suburban Detroit. You can see an interview between he and I elsewhere here on the channel, Elder Law Attorney, certified elder law attorney. Anyway, back to the guts here, which is that, this is going to be ultimately what I'm going to say. Ultimately, this is what I'm going to say. And let me just say that for paid subscribers to Jay's Corner, right, I'm going to be sharing the slides. They're mine, right? The C with the little circle at it, that's going to have my name, right? So I get to do what I want with it. That said, so yes, I'd be happy to share it with you. Absolutely. Ultimately, what I'm going to tell you is the following. That it has been that healthcare cost planning is neglected by advisors. And, this has been the subject of an article that was sitting on Alliance for Lifetime Income that I did not write, right? Which is, it's not only Americans, right? It's not only in. The entire financial guidance industry, right? Stock Pickers Inc., right? Stocks in the Long Run, Inc. We're not going to debate stocks for show, bonds for dough here and today. We aren't going to run out of time. Okay, but my point is that healthcare cost planning is the most important, and it has to be done first. This is arithmetic, the arithmetic of money. That means order of operations matters, right? If I'm Mr. Sick a lot with stage 4 pancreatic cancer, guess what? I don't have to worry about the duration of my portfolio being 20 years. Sorry. In the absence of medical miracle, 20 years is not on your horizon. And I hope I'm wrong. I'm probably not wrong. It's not only that. Of course, there's an entire practice of people and everyday common sense, right? Which is that it's not only the money, but it's also the fact that people have to disrupt their life, right? They have to stop working. They have to work less. They may have to go from working to stay at home in order to be a caregiver of a family member. These are scenarios that happen all the time, right? You'll know them. You can remember 2 videos ago, I pointed out about the disparity in earnings and retirement savings between men and women. And I just said, look, it's not only the gender bias, inherent gender bias that exists in the United States, but in addition to that, it's the fact this extra gender defined role made women stay at home if someone got sick or to raise young children, for example. So the obvious ripple effect being that money is less for that more than 50% of the population. By not addressing these matters, for me, and just to skip to, oh, growth stocks are better than value stocks, or ignore the equity risk premium and these kinds of things that you see on CNBC from basically from, I don't know, 10 a.m. to 5 p.m. is odd, is as nicely as I can put it. It really is. It's the nice version. And it represents opportunity to them, right? Which is that if, and people hear financial planning clients, right? Comprehensive financial planning clients, you can see it on gh2benefits.com. That's not what I'm here to tell you about, but our clients, they candidly, they have no choice, because I force them to go, hey, look, let's talk about this thing first, right? Tell me what this looks like. Tell me what your approach is on this, because then I can get an idea of how much something's going to cost. And from there, then we can make the other pieces fit. Whether you are financially struggling, whether you have, money for days. And the opportunity, therefore, is to then, right, to stabilize our practice. The risk is also now becoming self-evident. I've spent a lot of time, right, on this channel and other locations in appearances, etc., for example, which is talking about the APTC and talking about IRMA. Sorry. Right here it is, right here. My note for the Alliance for Lifetime, it's a research note, institute note, apparently. So you can go to the website. I will include a link in the text after I'm done broadcasting. And what it does is it goes through the interaction between healthcare cost planning and financial markets holdings. And that is not part of this article. But this then is the opportunity that exists for people, because now the reality is that, ultimate portfolio performance will vary greatly, and more than the advisor community knows. A lot more. APTC from that paper, it can be what? $18,000 a year? $20,000 a year in Florida? This is $24,000 a year. A year. Just think reasonably. If portfolio 1 and portfolio 2, right, differed in performance by anything close to that. This one made your net worth, which is the only thing that you should be focused on, right? How much money do I have to spend for stuff, right? For $7 Cheerios, right? I don't care how he got there. I don't care what the composition was. I'm focused on what's our amount of net worth that we can turn into money that we can use. Well, if you understand this interaction, portfolio one, let's call it $18,000 better a year for 3 years. And that year starts today. Guess what? This person is way better off than this person. And it's not close. It's nowhere near close. Because all of these things are all true, right? Because we're not, and I've talked about these other topics. You can see it. Sequence risk. Oh yeah, always at the red arrow. These are topics that you've seen throughout Jay's Corner. Please go and go through them. I know it's a lot. Of course it is, right? This is complicated web we are describing here. I understand that. That's why I have to repeat myself often as well. So now you can see here that ultimate portfolio will vary greatly. This should be just common sense. Look, the one I took advantage of this. One person, one advisor doesn't, because they've blown it off. Why? Because they've underestimated how important it is and neglected it is. They didn't know necessarily what this is. They didn't realize how much this can be. This here, IRMA, which is part of Medicare, right, is $500 a month, can at the highest end, times 12, right, and then times 2 if you're married. So it's $12,000 a year. Now that's the rubber band stretch all the way to the maximum, right? But that's a very good approximation. The IRMA portion is $12,000 more a year, plus base Medicare. So my point being that also is the risk. Advisor 1 knew this was a topic and planned around it. Advisor 2 just was like, well, I can pick, stocks. I'm good at cherry picking stocks. Right? I say, look, you're at home, you're the caregiver, and now one of your family members needs immediate medical care. Are you really that happy that this person has chosen Ginnie Mae mortgage-backed securities compared to Fannie Mae mortgage-backed securities? If they know the difference, I do, because that's my original home, right? That's my point. Let's continue. There are other risks on the horizon, and you can see why I've described them, right? Which is that active indexing is a real risk. So active indexing for newcomers is basically an optimization program, optimization exercise that people are using for selection in order to deal with taxes. Well, since these are tax matters, APTC and IRMA are tax matters, which I discussed in my note for Alliance for Lifetime Income, right? That what I basically said here right off the jump, right? Which is that are a tax. Healthcare costs are a tax. And now you can understand why I created this little corner of the planet. Right? And if active indexing is there to systematize and optimize the fact that you can avoid this stuff, now it's not going to be that easy. You still need guidance, but my point is, this person over here who is, hung his shingle on Ginnie Mae versus Fannie Mae mortgage-backed securities, or agency versus non-agency, or CBO versus, mezz versus, junior mezz in bank capital structure. They don't, trust me. But my point is if that's where they're hanging their shingle, Now all of a sudden they're overwhelmed by this because of these. And the thing is that I'm not splitting atoms here. I don't believe that. I believe it is just your common sense, right? I've pointed out portfolio composition intentionally. Why? Because I'm there to tell you, like, look, it's real hard for Vanguard targeted date fund to distinguish itself from BlackRock targeted date fund. They fight hard, and it's not because they're dumb. No, oh no, right? Unlimited computing power, unlimited certain handle of the theory. Access to every financial market, undoubtedly. So as a result, my point is this then is the marginal difference amongst advisors, planners. That's my hill. That's my hill. Right? And that is what I'm going to basically be saying. Now, I got to be nice about it and more polished about it. And I'm going to have to, try not to swear. And well, I'm pretty good at not swearing in public. But you understand my point, which is that to be encouraging to them, because this also then does represent a big opportunity for that community. And it has been neglected and it has been costly. It has been costly, which is that maybe as a result of you watching today's video and you've had some advisor for 30 years, I've had this quote, right? I'm very comfortable with them. You're very comfortable with them. And what if I told you that they didn't understand this? You get uncomfortable real quick. One last thing here is, I always got to talk about artificial intelligence. Yes, artificial intelligence is definitely going to affect this. Right, because as I've said, Vanguard versus BlackRock, real tough, right? Enormous amounts of computing, unlimited computing power, unlimited, right? So now they're just going to set their parameters, their requirements to say, okay, do this under this particular set of restraints. That's what they're doing now, even before AI. Okay, so now you're going to have AI tools. This, I'm sure, is coming. Very sure of it. I'm sure the hedge funds have already deployed it, which they will not share with you or the public. But the issue here is that I want to also swerve out of the way here to make the final point, which is not going to be a surprise. None of this doesn't. I'm just sorry. Right? Doing it, you would have to have command of the combination of every topic I've put up here on Jay's Corner, and then have the extra step of executing. This is an entirely different topic, right? Even if you understood all the theory of everything that I've said, each step, order of operation, there are some in this audience, I am very sure of it, the followers who have been here for a decade plus before there was a Jay's Corner, right? Some of that crowd, I promise, has hung around and stayed here because they knew from their own academic background, which exceeds mine by many times. I promise you that, right? That those persons said, oh, that can't, logically could not be false, right? So therefore, if it couldn't have been false, therefore it's true, right? They could apply their own knowledge. They could just erase their own jargon, hear what I was saying, go, oh, what he was really saying was that I've seen this before. I have a PhD in it. They do. Right? So my point is, even if you could do that, that does not mean that you are the one who could sit at the control stick. That's different. That's an entirely different topic. Which makes it in common, very much common with Medicare healthcare cost planning. Absolutely. All right. I've spoken very quickly here today. I'm out of breath. I want to talk about Friday. This segment, we're going to talk about financial markets and what I saw, my observations. Today's not financial advice. None of my videos are financial advice, everyone. Not one, right? That's your risk. I don't know you. I don't know what your priorities are, etc. Friday was a crazy day. But I thought that this would be very, very instructive for you, to give you an idea. Right? This is not what I'm trying to do. This is kind of just the watch list that I have showed you in the past, right? I've showed this to you in the past. Let's just see here if we can get to graphs. Let's look at the chart. There we go. This is Friday. Okay. So as I adjust the size, what do you see? You see some wild change here at the end of the day. This is Friday during the afternoon. I'm sitting there watching as I'm, mulling over other things that I've, not things I'm supposed to do and aren't done. And you see some crazy stuff. Look at we went straight down, and then at the very last moment, straight higher and higher on the S&P 500. This is SPY, the ETF for the S&P 500. This is NASDAQ. Never returned basically exactly to the high for the day, etc. You could see it. And it started out down, stayed down. This was looking very nasty. I'm going to switch the order here, right? And this is my main-ish observation about Friday, and it's here. Oops, let me just move this here for you, right? Which is that it was a very specific type of day. Very, very specific. Number one, it's Friday. Right? But this Friday, every week on Fridays is something called options expiry. I've discussed that about NVIDIA, about the fact you've had this incredible intraday movement in percent terms, and that was about 6 weeks ago, and how it is screwing up, skewing the calculation of the indexes as a whole. We're going to get to that. But it was not only options expiry, but is also month end. And the point here is that the fees that occur on mutual fund, hedge fund, whatever wealth managers, it is determined by month end pricing, which means that you can't manipulate certain things, but even the big indices, and you can see down over here, down this bar. I'm not sure if you can actually so this bar down here, which is kind of cut off. Let me just include it. Oops. This bar down here is volume. Now we don't need to know very much, but to see that the amount of volume traded at the end of the day was this. What does this tell you? It tells you that games were being played during this way down. And what it also tells you is the following, to give you an idea what a bad idea it is for you to think that you can be a day trader, is you could see this stuff here on the right hand side. It's a histogram of how many of these particular contracts, or shares I should say, and this is QQQ. So how many shares are traded at what price? And from there, they make high frequency trading, more or less. And I'm not obviously not delving into the nth detail. Oh, by the way, right? What other exercise are people trying to, command in order to do this? High frequency trading is basically measuring this curve to the right. And you can see it here. So they're going to have their own opinions about when to buy or sell. It's going to happen quickly. It's going to happen, for a particular catalyst, whatever it would be. Okay. And the reason I'm going about explaining this in general, right? In general, this is what is going on, right? And you can understand then why my idea of you doing this at home alone, right? Even with guidance, this is a no. Very, very bad idea. The funny thing is that people do this, and then when they're successful, they say, look, I'm great. You have misspelled lucky, right? If you're using the outcome to say that you were able to have an edge, right? This is what I've been asking people to identify and articulate to me. Okay, fine. You think that you can do this. That's fine. Tell me what your edge is. Tell me where you are better than your competition who has full command of the lettuce. They are calculating this all the time, around the clock, with unlimited number of data points. That's your competition. That's your competition. Strategically. Now, strategy. So that is the short run, and that's what people would call tactical. Right? Tactical. So Financial Jargon Dictionary 101 by Jay, right? Tactical is the very short run. There's not really a tactical channel, right? There are lots of channels, how I made, $70 trillion day trading, that kind of thing. I'm talking about strategy here. Why? Because I'm going to under the presumption that you're not sitting by a screen clicking on fidelity.com. I hope not. I hope you have better things to do. The issue is strategy. You still do need to understand that strategy. Or you need to have somebody whose hand at the controls who does have the right understanding of the strategy. So important. Which is that people are like wrongly have, the message has from to the public has been, look, stocks in the long run. Yeah, that's very convenient to say stocks in the long run, and that's not necessarily wrong. But guess what? That's because this building block was straight, the denominator was straight down from basically your entire life with coordinated central bank action. Coordinated. We're going to get to coordination very, very as the punchline to this segment. So, a message here on this newsletter, on this channel, is stocks for show, bonds for dough. And that is basically saying we need to know what's going on with interest rates. Right? It doesn't matter who you are. It doesn't. The other day, I stopped from making a video I should have, because it was basically to, express my rage at a person on CNBC who basically said that these theoretic matters that I've talked about that Oh yeah, by the way, that central banks and the largest portfolio managers all use as inputs. He's basically was up there saying, I don't want to hear this talk. I don't want to hear that talk. I'm like, you've got to be kidding. One of these days I will make this video to ridicule this person. It is really disturbing. Interest rates have returned higher. I have pointed this out to you. So let's go under the idea that you have understood stocks for show, bonds for dough, meaning that the denominator is the bigger market, controlled and influenced by way more capital of way bigger agendas than you picking, Nvidia versus ARM. What we have here is the following, and we'll get to it. Let's just see. What's a fast way to get to it? Let's just get to it this way, right? If we look at, excuse me, ticker.tnx, let's just call it this way. Yes, so you can see this. Oops, this is not it at all, is it? There it is. So this is the 10-year note. This is the 10-year interest rate. The most important single number is here. Right, this is the yield on the U.S. Treasury 10-year note. There it is. And you can see that from here to here. And what we have been undoing, and you can see what has happened, right? Which is we had Fed speak. I then said, hey, guess what? The coast may be clear here-ish. Straight down, just for markets to reverse, right? So in other words, my point at that time was this entire period, in this screen here has been because this pink line has been jumping up and down in a more violent fashion than it had been throughout the rest of you can see it. This is from the beginning of the year, down here. Once you start breaking higher and spiking higher, the problem here is that, of course, that opens the door to this, which you must pay attention to because ultimately you are still only at the red arrow. Right? Nothing stopped once we start going here. Right? The guys with the computers and understanding, actual understanding on the largest markets also know it can keep going higher. And if it continued to go higher, then your only conclusion would have been, and rightfully so, what? Risky assets lower. And that's exactly what you got, right? I've got timestamps. Just go to the videos here. I've made more videos on Jay's Corner over the last 3 months than I have for the past, in those past weekends, as opposed to like the past 6 months combined. That's the reason, because once we start this pink stuff started moving up and down with speed and scope. Now the computer needs to turn on so we can see how it affects people's strategy, understanding. It has always been that way. I'm not changing the message of stocks for show from bonds for dough. No, I'm not. What I'm rather saying is, hey, the market has changed. Something has changed here. We need to have our radar on. And the reason is because it can affect your strategy. You can attach all my other videos to say, look, okay, now we've got this, and now does your strategy change given your personal situation? And now you can understand why I started this with the searching for Bobby Fischer scene. Here's the problem. So if you put your macroeconomics hat on, the issue here is you can remember here that I said that what you'll have is inflation getting the headlines. So what you are led to believe, for the most part, which is true, right? I'm not saying this is incorrect, right? That part of this pink line here is inflation plus inflation's expectations, right? We're not going to go into macroeconomics 101, right? But that is, broadly the current craze. Real rate plus inflation plus expected inflation. Okay, that's why that headline always comes up from the University of Michigan Sentiment Index. There's your reason. So you got interest rates higher, spiking up and down a bit. You can see here, there's a pretty good ramp up here, 435 to 462 with speed within a week. And now what you would have the losses in equities first time. Just want to point out these couple of other things is that ultimately still that securities are about supply and demand. The price, the clearing price is reported onto Mr. Market. Mr. Market is not determining the price. It's the clearing price which is reported to you. What is affecting this here now are these headlines, which do they predict tomorrow? No. Do they affect your strategy? Maybe. So here are your tidbits here from Macroeconomics 101. Is it maybe 102? No, it's still 101. Microeconomics 101, Markets 101, which is that, interest rates are determined by the solution on the price of bonds. Okay, that's the 10-year. What happens if the biggest buyer doesn't want to buy anymore? So I'm not a geopolitician. I'm not here to settle geopolitical debate. We don't need to. I've already used this as an analogy here on this newsletter on Jay's Corner, right? The richest guy in your neighborhood, even though he can't spell cat, if you give him the C and the T, he starts buying all the houses on your subdivision. Guess what? Your house, the value, the market clearing price just went higher. The end. The flip side is also true, right? The smartest guy in your neighborhood who, you dislike or whatever, he starts selling everything. It doesn't matter if you think that your house is like the best thing since the, Walt Disney World castle. Doesn't matter. Your price going down. And this is the issue here, is that I have made this point, which is this stuff here. Denominator down for basically decades, but it's not only that it's been down, but it has been unified. Meaning every time there's been a problem, ECB, Bank of Japan, US Federal Reserve, you name it. Everyone working together. However, now, you are now seeing that not necessarily. I don't think the dollar is going away as the reserve currency. I'm not in that camp. You can Google that for fun. That's not my macroeconomic prediction here. That's not my principal case. But can this occur where they are not agreeing for whatever reason, and the rational actor not be a seller of securities, and as a result interest rates to go higher? Well, guess what? Why do you need to know about this? Because this plus auctions affect your strategy, and by auctions you can see it where you can see it here. Yes. Move the equation out of the way, and what you get is stocks fall as weak treasury sale. So what ends up happening is the U.S. government has a schedule. They auction treasury bills, bonds, notes, and then there's a clearing price that's very carefully watched, because they know they're using something called the Dutch auction. We won't talk about it here, but my point here is, I think it's modified. Dutch auction is the technical name. But anyway, the stocks fall because why? During these auctions, the demand was much worse than the last clearing price and implied it would be. And that's what happened. So it explains what has happened over here, right? We've had terrible bond auctions, pushing up interest rates, rippling itself into equity. The issue is if you were to couple that with active sellers, now you can understand why now all of a sudden your strategy, now you can see the tangled web. This is not just, oh, I think this yield is great and you get this return on your money. My target yield is this, or etc. This is like, without a context of understanding of these other bigger picture matters, you are eating soup with a fork. Last point, making it not great, and you can see some of the ripple effects, is that NVIDIA is creating this issue. Right, so everyone at this point, even the ones living under a current events cave, right, knows NVIDIA. I've talked about it at length, not as a buy or a sell recommendation, but just to give you an idea. This is like, this is over a month. Let's just make this, 100-day, right? Dramatic rise. The issue is the dramatic rise here. Right, it would, let's just see if I can get to it. Yeah, I guess that'll do it. Yep, that's NVIDIA. Okay. The issue is that this security is skewing the definition of what is going into QQQ and then also into SPY. And my last takeaway here is, before everyone's all happy, that if I assigned equal weights to every stock, Jay's Rib Shack is the same importance as NVIDIA, which is also weird, but it's really for illustrative purposes, right? I mean, you can never say that Jay's Rib Shack is as prominent, important to the economy as NVIDIA. That's like ludicrous. Even though my ribs are the best. But you understand my point. So anyway, here we go. That this is just even within year to date. This is a lot different, right? This doesn't look too different, right? 4.8 to 10.6. It's a lot different. Right? If you told an equity manager, okay, one has outperformed the other by 5.8% for the first 5 months of the year, that is enormous. Enormous. Now in equity, more volatile, right? Because this underlying securities are more volatile. But in fixed income, for example, to give you an idea of scope and scale in the fixed income market, if you're off by like 0.1% compared to your exact competitor, you're going to have a business problem. If you're off by 10 basis, you're going to have a business problem. Absolutely. So my point here is that this kind of gives you a picture on what has happened here, that the biggest cap stocks have pulled the entirety up a lot more. Now, this is still very good, right? If you're talking about 5 months for 4.8% is high. That said, ag is going to be down, right? So, I mean, you can see here. And this is the bond market, everybody. AGG, kind of like your number for the bond market, down. So you can see a combination of these three items. You can see kind of what your returns to be. Not hard, actually. You can understand it. I didn't say you can just go and do this at home. No, I didn't say that. I said, okay, can everyday people understand? Absolutely. But I just wanted to leave that with you. Whew. I don't know about you. I'm wiped out. This has been Jay's Corner. Be sure to like and subscribe to the channel. I understand the channel does not fit the algo. I get it. There's going to be limited amounts of pushing out due to the way that YouTube works. That said, these are complicated topics as a standalone. Plus, there's interaction across the topics. And I'm trying to shed light on that in everyday language at the highest quality that everyday people can understand. Have a good Sunday.